we've been uncomfortable from the corporate governance issue from day one. We've been uncomfortable around capital allocation since day one. We've not looked at this business having platform-like characteristics. If you do a quick survey among 50 supply-side restaurants on Zomato, they will tell you what you need to know around whether it is a true platform or not. See, the business it's built a solid business, but does it have unit economic scale that we look for from a sustainable perspective? I don't see that happening. So it might have come out with EBIT margins having, let's say, reduced its losses and it's flat as far as the food delivery business is concerned. But a lot of things from a characteristic of the kind of business that we look for doesn't exist in Zomato, or even for its competitor in the private market. So there are other risks that even no one is even talking about. So, for example, let's say the ONDC, if that picks up, we don't know. It's still very, very early stages. It's a hypothetical concept. There are a lot of gray areas around how that would work. But that's the biggest risk in terms of the core disruption of the market itself. So not a big fan of the business model. The valuation only comes post the business model understanding. So I'm not even going to get into the valuation today.
Got it. Paytm, what's your sense?
If you ask me, Paytm, what my sense, if you make India pay for UPI, I think Paytm has immense value.
Let's assume it ain't happening because we go with the present.
Then my view on Paytm ain't changing.
Okay. What about PB Fintech? I mean, that's kind of built a profile wherein it becomes one of the first port of call for online digital insurance buying, so to say, in the minds of many. Is that a moat? Does that bring about some bit of platform-like characteristics, or no, not quite?
So it is interesting. I think the theme that they are playing on is the fact that India is an underpenetrated insurance market. And I think every theme that we play on, we keep talking about India being an underpenetrated X market. The reason I don't buy that hypothesis itself is I think the denominator is always miscued. It is not the denominator of our entire population. Maybe 15 years down the line, we could talk about a different base. But to me, the base is very different. So I don't think it is underpenetrated by any means. When you look at the earnings call of, let's say, HDFC Life, a Star Health, and ICICI Lombard, these are your supply side on a PB Fintech, right? They are building out their own digital avenues for acquiring customers too, right? So end of the day, if I have a true platform, my supply side should be on my platform rather than trying to find avenues of moving out away from my platform. It's a very simple characteristic that I say defines stickiness. So I've had arguments with multiple people in the industry, Neeraj, where most people in the industry love PB Fintech. I could be wrong, but I don't. I don't find those characteristics yet. But we'll see, because they are branching out into other avenues as well. They're becoming a bazaar platform rather than just an insurance-only platform. Not sure how that would work out at scale, but as we speak, as the business model is today, I don't see those characteristics that I look for in a business.
Final word on Nykaa. Since it's a portfolio company, you may be guarded, but just trying to understand, why did you buy in the first place, and does it still hold some of those characteristics, or have they enhanced those characteristics as well?
So enhanced is a bit of a big word to use because it's only been a quarter and a half, right? So it's end of the day, the lever that they have is the fact. So think of it this way. Today, most people I know, including my close friends, they used to go to France and US and Dubai to buy their perfumes and their cosmetics. Today, all of that is brought onto Nykaa at the same price that you get at US and Dubai. So end of the day, the availability is what they have solved for. And these brands are not going into other platforms because Nykaa has the bargaining power to actually bring in a unique brand at a sole distribution perspective, and the fact that they maintain inventory. So they can protect their margins as well. So there is a core moat that Nykaa has. The important thing to realize is branded BPC retail has the highest bankruptcies globally. So it's not an easy business to run. right? Which is why I feel competition is going to be low. It would be someone who can scale the unit economics both at an online and an offline model, which is what Nykaa is doing, will take a lion's share of the market share today. Now, the last part is, are the valuations justified? I think the valuations are very expensive. There's no doubt about it. The only thing that can justify the valuations is the growth that they show. That growth lever can come from B2B, which means it goes back to execution today. So the question is, do these promoters who own majority stake of the company continue to execute? And do they have the operational ability to execute on the ground? So far they have. And jury is out to be seen in the next 8 to 10 quarters. How will the results as well as the margins look like?